I don't know. I don't know.
Is that one of your biggest wishes?
Yeah.
I don't know. I don't know.
Is that one of your biggest wishes?
Yeah. Hey, g'day guys. Well, it ended up a pretty tough week on the market, I must admit. I was going okay right up to Friday when I bought some big BIG. Now don't look at them, please don't look. I had a terrible day and lessons learned. Market doesn't like it if they don't trust the management, and I think that's the case with this company. Management is not fully trusted. But anyway, that sort of put a dampener on my week, and overall the market was obviously down a fair bit. So it was an interesting week. But that is not what I am going to talk about today. I am going to talk about the American investor Peter Lynch, and specifically what I like about Peter Lynch is how he breaks down companies into certain categories, so that when he looks at a business, he doesn't treat all businesses the same. He looks at them with different sets of glasses on, because what you don't do is apply the same criteria to all businesses, because all businesses are at different levels of their development. And a bit like as a parent, you don't apply the same rules to say a toddler as you would a teenager. And it's the same with a business. You just have to identify what sort of business you are looking at and then apply that certain criteria to that business. So that's what we're going to look at today. Okay, so who is Peter Lynch, firstly? Okay, so straight from Wikipedia, Peter Lynch is an American investor, mutual fund manager and philanthropist. As the manager of the Magellan Fund at Fidelity Investments between 1977 and 1990, Lynch averaged a 29.2% annual return. He has also co-authored a number of books and papers on investing and coined a number of well-known mantras of modern individual investing strategies, such as invest in what you know and 10-bagger. Okay, so Peter Lynch is a legend of the American investing scene during the 80s, at which time he was better than Warren Buffett. Probably not as famous as Warren Buffett, because Buffett has done it for such a long period of time, where Peter Lynch was more, that decade of the 80s where he just outperformed the market, and yeah, just a 30% annual return. Is huge. To do that consistently over a 13-year period, that'll make you quite wealthy. Okay, so now, as I said, when you are looking at a business, what Peter Lynch would do is he would quickly identify at what stage of development that business was at, and then once he knew that, he could ask the right questions. He could look at the balance sheet of the business, and obviously if it's a startup, or what he called a fast grower, he's got to be asking different questions, because that balance sheet is going to look very different to a business that might be a slow grower, or a asset play, or a cyclical. Okay, so if you don't identify what business you're looking at, you don't know what questions to ask. Okay, so the 5, I've already given them away, but the 5 categories that Peter Lynch had are the fast grower, the slow grower, the cyclicals, the asset plays, and the turnarounds. Okay, so the fast growers, these are probably the ones that are the most fun to try and identify, but they're also the hardest. When they're initially growing fast, it's hard to try and predict the future, whether that growth will continue. but they are the most fun. A company like Tech at the moment, which is really turning it on, and Afterpay, another one at the moment. There's just a couple who are growing really fast, small businesses that have increased their revenues so quickly over a short period of time. They're examples of fast growers. So when you're looking at those, you've got to ask certain questions about early stage of development. Their balance sheet will not look as strong as a slow grower, but it doesn't need to look as strong because the growth is so quick that they can quickly improve that balance sheet if things go right. So the second one being the slow growers, I guess you can put the banks into that category. The initial surge in their growth is gone, and probably will never be back for things like the banks. But of course, there's still good investments. The returns, the dividends, those sorts of things are generally higher on these sorts of companies. So a whole different set of questions needs to be asked. You will buy these companies at different stages of your own investing lifestyle. So you need to identify what is a slow grower. Now the cyclicals, of course, the mining shares go in there, your BHPs, your Rios. They can be great fun to play with at the right time, and they can be a disaster if you're in them at the wrong time, because these cycles can take decades to play out, or many years at least. So you wouldn't want to time these shares wrong. So if you're looking at a cyclical, you've got to know you're looking at a cyclical and identify when is a good and bad time to be in these types of companies. The fourth one, the asset plays. Now, these are the ones that have great brands, so maybe a lot of physical assets, maybe a lot of intangible assets. A company like Coca-Cola, probably the greatest brand in the world. You can look at West Farmers with their Coles and their Bunnings. They have these really hard to value intangible assets, but they are assets nonetheless. And you'll probably put Telstra in there as well. Although companies like Telstra can fit into a couple of different categories, and that's true of a lot of companies. They may be in more than one category, and they may change from one category to another, and you've got to identify that as well. The last one being the turnarounds. Now, they're always good fun to try and identify. Recently, Elders has been a massive turnaround story. You could see it taking place like the Titanic. They were trying to turn this ship around, and they seem to have done a wonderful job with that particular company, going gangbusters over the last year or so. Now, these are a bit like the fast growers. They're fun to try and identify, especially because everyone seems to hate these companies. And it wasn't long ago everyone hated Elders because the company was running poorly, because of the live sheep exports and live cattle exports that they were involved in. So they had a lot of people downplaying the company, and they've managed to turn it around, not just the numbers, but also in the minds of people. So these can be fantastic businesses if you identify them at the right time, turnarounds. So that's 5 categories. There's probably more. That's just the ones Peter Lynch identified. And what I'm saying is you can come up with your own categories. There may be 10 different categories that you can come up for yourself. But the point being that you need to know what category your business is in, and you need to identify that fairly quickly when you're looking at a business, so you can ask the right questions and identify what the answers should be, and compare it to other companies in that same category. So you are comparing apples with apples and not trying to compare a fast grower to a slow grower or a cyclical. Okay guys, so I think this is really important information, and probably I should have done this video yonks ago, because I've talked about researching companies, but I haven't actually spoken about the different criteria you have to set. So this is what this video is about today. Have a think about it. Get onto YouTube and watch a few of Peter Lynch's YouTube videos. It's really easy to listen to. He's got a fantastically slow sort of drawl voice that I find really easy to listen to, and I prefer him as probably one of my favourite investors of all time. And he's also written some good books. Can't think of the names off the top of my head, but I'm sure if you Google Peter Lynch books, I think he's got 2 or 3, and I've read a couple of them, and they're really good reads. A lot easier to read than, say, The Intelligent Investor that Warren Buffett swears by. That's pretty laborious, where Peter Lynch's are a lot easier, especially if you're beginning. Okay guys, that is it for today. Again, I hope you've had an okay week. If you haven't, there's always next week, and there's always next year, next decade, so one bad week shouldn't ruin it forever. No worries, I'll talk to you again next week.